Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 18th of January 2016 and we are looking at the question, will the Chinese economy collapse in 2016? We are all very much aware of the impact China has on the world economy. We have already seen commodities and stock markets plummet as a result of its economic slowdown. And this causes one to question whether its economy can survive and prosper, or if total economic collapse is possible. One of our economic colleagues sent us this brief report, which we shall read verbatim. An economic collapse may occur due to the government's inability to support state-subsidized industries, as well as capital flight, prompting a devaluation of the country's currency. Seasoned financial analysts state that conditions in China look as bad as those in America just before the 2008 crisis, or Korea during the 1997 Asian crisis. While some analysts and investors disagree with this outlook, they are quick to accept that China's economy is headed for at least a gentle slowdown. In a recent report, the Bank of America claimed that the country will experience currency devaluation as it changes to a services-based economy. Market forces will thwart the Chinese authorities' efforts to control the economy, and capital flows through official diktats. In addition, major companies in key industries seem to be on the brink of a liquidity crisis, while the ability of repeated fiscal and monetary stimulus packages appears to be diminishing. Should Chinese stocks continue to experience a steep downturn, as currently witnessed since the beginning of this year, it will be a departure from 2015 when the country's equity markets held up compared to its counterparts, as the government took measures to prop up share prices. In its forecasts for China, the Bank of America sees a softer landing towards slower growth. The bank says that the economy will grow by 6.6% in 2016. This will be a little less compared to 2015's estimated growth of 6.9%, or what we believe to be officially announced 7%. To support a flagging yuan, China has been deploying its foreign reserves, which are pegged to a basket of foreign currencies, such as the American dollar. According to Trading Economics, foreign reserves in China fell by $87 billion in November to $3.43 trillion. This was the lowest in almost 3 years, as they were at $3.99 trillion in June 2014. However, announced only last week, they fell another $107.9 billion in December to $3.33 trillion, an even larger monthly drop. According to Reuters, China's central bank, commonly known as the People's Bank of China, is experiencing real challenges in controlling the yuan. As a safety measure, the government has banned 3 foreign banks from foreign exchange transactions until the end of May. Banning banks from operating on the offshore markets raises questions about the status of the free market of China. When this move is scrutinized keenly, the ban appears to be in contrast to the government's ambitions to internationalize the currency, especially after the International Monetary Fund included it as part of its special drawing reserves in December. Suspended services include the ability to liquidate clients' positions and other cross-border offshore and onshore transactions. There are indications that the PBOC has not given any explanations about the motive behind the ban. Speculations are rife that the banks have been suspended due to their significant involvement in cross-border foreign exchange operations. In August 2015, China sent global markets reeling when the country devalued its currency by about 2%, in a surprise move not witnessed in more than 2 decades. That move sent signals to investors indicating that China's economy was experiencing more trouble than what most economists had thought. The move also sent ripples across Asian countries, which responded by weakening their currencies to enable their manufacturers remain competitive. Additional yuan devaluations this year just further cement this view. China decided to weaken its currency in the face of speculations about Federal Reserve interest rate increases, which strengthened the American dollar, a critical part of the country's currency peg. A strong American dollar drove up the value of the yuan and crimped exports. While it is too early to know the impact of the IMF's approval for the tender to be included in a special basket of global reserve currencies, analysts say that such a decision is likely to see trillions of dollars of investment flowing into yuan-dominated assets. These analysts wonder whether China has enough reserves to successfully defend its currency. At the moment, it seems to have about $1.5 trillion of potential foreign exchange liabilities. These consist of inflows to debt and equity markets, loans from overseas, and carry trades deposits. While the Chinese government may opt to depreciate its currency to help exporters, such a move may make matters worse if capital flight occurs. Real pressure is likely to come from investors seeking to move their money out of the country before further devaluations. Currently, many influential Chinese are moving their money to foreign countries due to the diminished prospect of domestic returns, as well as an increasing risk of corruption investigation instigated by the government. If there are any aggressive moves to sell dollars from foreign exchange reserves, as some predict, it may very well tighten domestic liquidity and thereby trigger the very conditions that resulted in capital flight in the first place. In other words, a vicious circle. The entire situation is clouded in mystery and dubious statistics as government tries to bail out companies in what some may regard as shady, barely disclosed deals. At the moment, banks may be holding bad loans at a rate of 15% compared with the 1.5% the government has forecast. The situation has all the characteristics of the debt build-up in mortgages and mortgage-backed securities in the period that preceded the American financial crisis. Part of the problem of the Chinese economy is that it has been based on the policy of extend and pretend between the enterprise and financial sectors. If the fabric comes apart, there will be serious collateral damage. In addition to the issues already stipulated, rising political tension in Eastern Asia is likely to affect the economic and financial mood in the region. This may heighten the possibility of a market crash or the collapse of the Chinese economy. In addition, Beijing's effort to assert its authority over the South China Sea and the increasing construction activity surrounding structures that look like military facilities are fanning fears and concerns among neighbouring countries with competing interests in these areas. In an effort to challenge Chinese authority in the region, countries such as Indonesia and the Philippines prefer to favour US policies in the area. These countries are also increasingly supporting the rise of a strong military in Japan. The victory of the DPP party in Taiwan is likely to heighten tensions as it is sending jitters in Beijing. All these negative repercussions will have an impact in the Chinese stock market and could potentially bring down the Chinese economy in 2016. So, what do you think? Do you agree or disagree? Our broad consensus is that there will be a serious decline in economic growth in 2016 for China. But we are not quite persuaded yet of an all-out collapse occurring. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website regularly at www.illuminatisilver.com. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.